Hello, and welcome to the Getting to Your Retirement Exit podcast by Jenny Jones. I am your host, Jenny Jones, and what I want to talk to you about today in episode 27 is 6 reasons why cryptocurrency should not be part of your retirement plan. Now, in episode 27, I want to share some things with you or some disclaimers. First of all, before people start writing into the show or sending me emails or blasting me all over social media, this particular episode is really strictly geared towards retirement, pre-retirees or people planning to go into retirement. This has nothing to do, I'm not bashing cryptocurrency. I'm only trying to educate the particular listeners of this show who are on their journey and their path to their retirement exit. Now, I wanted to get that out of the way because I don't want everyone going all over saying, oh, he doesn't know what he's talking about or whatever. I'm just going to lay out 6 reasons why, if you're on your journey and on your way to retirement or you're a middle class worker or working class, not millionaires, right? My audience is not millionaires. I don't try to cater to them. My audience is the everyday working professional who's maybe in middle class or the top middle class, or maybe even the beginning stages of moving into upper class. And so that's really my target audience, and that's who I prefer to cater to. Now, there's other podcasts and other streams out there that may beg to differ on some of the arguments that I may lay out. Then there may be some that may not even have an argument for what I'm about to lay out here. But so here we go. So you need to understand, first of all, what I've figured out is, I'll say this initially and you can draw your own conclusion, but there really appears to be 2 camps when it comes to cryptocurrency, right? And when I say there's 2 camps, there's one camp that says, hey, I invested in it and I've been in it for a long time, maybe since the early, 2012, 2010. I think it came out around 2009 or so. They believe the technology that's behind it. I mean, I'm not even going to argue with the technology that's behind it, the blockchain and things of that nature. I think it's a very good technology. I have 0 issues with that. And so there may be some early investors who have gotten into it early on. Maybe on paper, the value of what it has grown to on paper is astronomical. I'm not going to argue that. I even know some people who have the value that they have because they've been in it for so long. They've just wrote it up and down. And I'm not arguing what they're saying. So that's one side of the camp. They've been in it so long. They see the value. You can't tell them, you can't argue with them that they are not worth $500,000, $250,000 on paper. You can't argue with them. There's no arguing. There's no reasoning with them. So that's one side of the camp. Then there's another side of the camp that says, hey, I want to get in, but I don't understand it, so I'm just going to steer clear of it. So there's just really literally 2 sides of the camp. And I'm on that side of the camp. It never interested me. I never wanted to invest in anything that I really truly didn't understand. The second argument is I have to invest in tangible, right? Having a background in accounting and finance and understanding the economics of supply and demand, understanding how to read financial statements. It never interested me because I never knew what I was really owning, right? And I'm not a currency investor, right? And I'm going to lay out some ideas on that too as part of my 6 steps. There are some fundamental underlying differences when it comes to currency, currency trading, whether you're trading different currencies or cryptocurrency is totally different than investing your normal currencies that you would trade. Now, so there's really 2 sides of the camp. There's people who say, hey, I believe in it. It's I'm going to ride this until the wheels fall off. I have 0 problems with those people. But then there's other people who says, hey, you know what? I just don't understand it. There's a lot of questions that no one can give me answers to. right? And then there's other people says, don't worry about the questions, just invest in it. So again, there's two sides of the camps. But I want to be able to try to separate some myth when it comes to retirement, because that is my area of expertise, and those are the people that I am concerned with, people that are trying to get to their retirement exit. All right, so let me give you the first. Reason, right? So the first reason, and again, we're talking about retirement. So if you're a high end, investor, you invest, you got 2, 4, 5, 6 million into cryptocurrency. This is not for you, so you can turn this off or someone else, right? So the first reason, the first reason it should not is there's no regulation, right? It's still in its infancy. It's taken them almost 20 years just to kind of figure out, it's something new. It took them a while, it took the government a while to try to figure out how to, tax the internet, right? And so when government catches on, when they eventually catch on, if you haven't already been in it, then, you've already missed your opportunity, right? So by the time the government catches on, or by the time they catch up with it, then the money would have already been made. So let me give you an example. So because there is no regulation, that to me is fertile ground for a lot of people who are uneducated when it comes to risk, or who does not have the sophistication in playing in this space to be involved. So if there's no regulation, basically, if the guy that's coming to cut your lawn, right, and there's nothing against people who cut lawns, right? That's what's so difficult about being on podcasts. You're trying to not to offend anyone, right? So the person that comes, your gardener is coming and cutting your lawn. That's what he does, or he or she does. If they're telling you they're in cryptocurrency, and you're like, okay, if my gardener is in it, then should I be in it, right? And you ask your gardener, or your hairstylist, or the person that pumps your gas, right? Some places they still have people who pump their gas. So anyway, and there's nothing against that. That was my first job, right? So I don't have anything to do with that. Listen to one of my podcasts when I talk about when I used to pump gas. I think it was episode 23 or 24, and how I got how someone came and says, "Hey, I have a deal for you." I was actually working on the gas tanks at that time. But anyway, I digress. So listen, if normal everyday people, right, the janitor or whoever, the person, the street sweeper, or the dog walker, or anything, any of those people just with normal everyday jobs telling you they're in cryptocurrency, to me that says there's a lot of inexperienced or non-sophisticated investors in cryptocurrency. And the reason why they're in it is because there is no regulation, right? So when you look at the normal markets and you look at, the stock market, things like that, there are some regulations that happen that, you have to be a sophisticated investor to invest so much, or someone to be telling you to get into speculative investments, which this is very speculative. Speculative mean, hey, I could hit a home run, or I can lose everything. I can lose my shirt, right? So this is a speculative investment. There are rules in our current industry right now when it comes to the stock market around speculative investing, right? There is so much documentation around speculative investing, right? You can't just hop in. A normal everyday person can't just jump out there and start investing in an investment such as this. But because there is no regulation, you do have normal investors. You do have inexperienced investors investing in cryptocurrency. So to me, that's one problem for me, right? Because if you have uneducated, unsophisticated investors, everyday people investing in cryptocurrency, it's almost like they don't have a respect for the market, right? Or the movement of the market. That's why cryptocurrency is so volatile, right? You can wake up tomorrow and it's down $200 billion. which was the case just the other day. You woke up you went to bed and you was up $1 million. You woke up the next day and you're down $1 million, right? That could actually happen in cryptocurrency at this current state. So as you're listening to this podcast, I don't know, this may be a couple of years from now, you may be listening to this, but from this day, from what I'm putting out, episode 27, this day, there is no regulation, and it is too volatile of a playground for normal people to be trying to put their retirement savings or trying to hit a home run at the last stages of retirement into this particular vehicle. Now, so that's one. Doesn't have a lot of regulation, right? So let me give you an example. Let me give you probably the best example for the no regulation. In the regular stock markets, they have what they call these alarms, or they have the name escapes me right now, but in the markets, you would not have a $200 billion loss, right? They put these stop loss. I can't remember the term right now. It'll probably come to me later. But they put these protections built in place so that the market can't drop in value $200 billion in the matter of minutes, right? The market has its built-in protection that protects it. It says, hey, let's cool the markets. Let's shut the markets down. Let's cool, right? Let's not overreact. Let's give people an opportunity to digest the news that just dropped, right? The news that just came out. And the reason why it dropped $200 billion is like overnight, like within a matter of, a couple hours, is because our current president came out and says, hey, I am going to tax long-term capital gains. I'm going to increase the taxable for long-term capital gains, right? And so when he did that, that means that everyone who has been in the cryptocurrency for any time longer than a year, they are going to be subject to long-term capital gains. And what that means is there's a lot of people on paper that's probably up $1 million, right? Or 2 million or 3 million in cryptocurrency. But if they're going to change the tax structure, the tax obligation against cryptocurrency, for all those people that's been holding this since 2014, 2010, right? There's people who've been holding it and they're probably up a couple of $1 million. Those are people saying, hey, I need to get out so I don't get taxed. So the tax does not hurt me as much as it would if I got out now. So if I can get out today at 35%, I don't want to get taxed later once this becomes regulation. I don't want to get taxed at 45% or 55%, or 10 or 15% swing in taxes. So that would erode into some of their growth, right? And so that made sense. So that's the reason why we woke up. You saw a $200 billion drop in the market. Now, with that being said, that moves me to IRS Notice 2014-12 on the taxation of cryptocurrency. Now, I don't know if this has been in chat rooms or going around on Twitter or Instagram or something like that, but there's this notion that cryptocurrency is not taxable, and that is not true. If you look up IRS Notice 2014-12, cryptocurrency is taxed like any other currency. You're taxed on your cost basis to your gain. So if I put in $1,000 and it goes to $2,000, I'm going to be taxed on that $1,000 gain, right? And so you are taxed like any other currency in that aspect. So when the regulation came out, when the proposal, and this is just a proposal, it's not anything that is in stone yet, but this is a proposal, I think, that is put on by the current administration. that there will be an increase. There's a possible increase in long-term capital gains. And why is that? Now, if you've been listening to me any time or have known me for at least more than an episode, you will know that I always talk about trying to protect your retirement assets by any cost, by any means necessary. If you definitely need to listen to the case of a Roth IRA over a traditional IRA, I forget what episode that is at the top of my head. I can't remember what episode that is, but I tell you that because we have all of this stimulus packs and all this money we're creating, and our deficit is increasing, and I keep telling people the deficit will need to be paid for, and that cost will need to be recovered, right? And so one of the ways that the current administration is going to deal with it, they always start looking for these different ways. Hey, how can we tax? How can we create taxes to recover this cost? And one of the ways that he is thinking about is increasing long-term capital gains. Now, it's increasing long-term capital gains for the wealthy. I want to say, and I don't have all the information, I haven't read into all the proposal yet, but from what I understand is you have to be, it's for those who make $1 million or more on an annual basis. So it's for millionaires, right? And one thing I know about millionaires, right? Working with them, I'm by no means a millionaire, right? That's not really my goal and purpose. If I get there, if I'm almost there, if I'm there, that's not what I live to do. I live to educate and empower people who do not know. And I try to break down things in small, palatable, bite-sized pieces. But one of the things you need to be concerned with if you were in there or if you are banking everything on cryptocurrency is only millionaires and billionaires could move that type of market, right? That's the amount of cost to just get into cryptocurrency today is several $1,000s to own one coin, right? And so the only people that can move a market $200 billion in a matter of minutes, in a matter of hours, are millionaires because they have a lot of the wealth in the cryptocurrency. If the cryptocurrency moved $200 billion, it was moved by millionaires, which takes me to, so we already talked about 2 points already. We talked about no regulation. We also talked about the IRS notice, which people were unaware of and that people are starting to become more familiar with, right? That's a reason, right? Another reason is pump and dump, right? And that's a term that was used and still is used. It was part of my exam studying for my securities license some time ago, is when people artificially inflate a stock or share to get others involved in it. And then once it gets to a certain amount, they start dumping out, right? So if I'm in at $20, I don't know, and then it falls to 10, right? If I get enough people to get the share and get enough interest to it to to go back up to 21, maybe $25, when I originally got in at 20, now it's down half to 10. And I told everybody else, hey, buy it, start getting in these chat rooms, start pushing it up. And it gets to $25 or $23, I then start dumping it, the amount of shares that I had, because I owned it at 20. So once I got it back above 20, or at least where I broke even, then I dumped it, right? So that's the whole premise behind the pump and dump. This particular currency has the ability to do that, right? It has the ability to, people get it to a certain amount and then they dump or they jump out of it. So it's called pump and dump, artificially inflated. People go around telling you what they own and what they have. That's 3. So that's no regulation. 2, that's IRS notice, right? A lot of people didn't know, but you are taxed on cryptocurrency, right? And then the pump and dump, right? So the pump and dump practice of going into these different chat rooms and these different back rooms and telling everybody to buy it and all that other stuff. And let me give you four, right? And then the other two I'll kind of talk about a little bit later, but I wanted to kind of give you these, and I'll probably just do a recap on all of them before I close out this podcast. But there are a lot of wealthy people, and I'll call them wealthy influencers, that we may follow. Now you have Twitter, right? You have Twitter, you have Reddit, you have all these other areas. You have, what's the new one? They have Clubhouse. You have all where you can actually talk to wealthy people you would never in a million years have an opportunity to even have a conversation with, to even listen to. I think Clubhouse allows you, the app Clubhouse allows you the opportunity to listen in to a millionaire and telling you some of the moves that he or she is making. If they tell you, if I follow a millionaire and they tell you, hey, I'm buying, Bitcoin, I'm buying Ethereum. If I'm buying any one of those, you're going to try to do what you got to do to buy the same thing that the millionaires are buying, right? So I call them wealthy influencers. So it has a wealthy influence effect to it. So that would be, let me see, no regulation, IRS notices, pump and dump. That would be 4, right? You have wealthy influencers. So of a wealthy influencer, again, a wealthy influencer is not regulated by the Securities and Exchange Commission, right? They're not advisors. They're not financially, they're not subject to regulations when it comes to the Securities Administration as the 1940 Securities Acts. They're not associated with that. They're just a wealthy person that made all their money, right? So but because you don't know that and you just like following this person, then you may say, if that person gets on Clubhouse and you have access to them and they say, well, yeah, I'm buying this, you're going to go and try to buy that. Well, they're buying it. They probably buy 2 million shares of it, right? And you probably can only afford $200 worth, or maybe $2,000 worth, or maybe $5,000 worth. Well, they're buying $2 million. They're buying $5 million worth. Right? Which is a drop in the bucket, not really that much money to their portfolio. It is probably for a person that's gotten that rich, they've probably taken a lot of risk in their life. Some have paid off. Probably majority of it has paid off in their careers or their lives, but they know if they take because they have a certain amount of money that they could deem to be speculative, right? And here's the whole thing with cryptocurrency. If it hits, a lot of people are going to win, right? If it really becomes an actual currency, I think you're starting to see a lot of entrants. You're starting to see a lot of credit card companies and a lot of, PayPal. You're starting to see a lot of companies get behind it because they're thriving, they're clamoring for a new type of currency that can be exchanged. And that's going to lead me to my my 5th point. Right? If they're trying to do all of that, you got a lot of big money, and that leaves me as an investor in cryptocurrency. That gives me hope that I'm just not in this for nothing, right? Here's a question. If you asked a cryptocurrency investor, why are you in it? Tell me why. You're going to get a million. Ask 3 different ones, right? And this is for your own research. Ask 3 different ones, or ask 4 or 5, and you're going to get 5 different answers. No one's going to tell you. Right. They're not going to be able to tell you the reason why they're in it. They're not even going to tell you really what they're invested in. You can say, hey, what are you invested in? What's the tangible asset on the other side? Right. And that moves to my most important point, probably out of the 6 points. My most important point is there's no correlation to inflation. Right. And that's the 5th point. There's no correlation to inflation. Whereas normal currencies, right, that people that do trade currencies, there's a correlation to inflation, right? And inflation, again, as I explained to you, what inflation really is, it's the erosion of the dollar. If I go in a store and buy a loaf of bread and it's $1, I go in next year, that same loaf of bread is $1.04, or it's the same loaf of bread just with less slices, or it's the slices are thinner, right? The funny part about that is I was in the store the other day. My wife left me to my own vices, so I had to go buy a loaf of bread. And I noticed when I got home, the slices of bread were smaller. They were thinner. And I always bought this type of bread. I said, man, the bread is thinner now, right? That's inflation, right? It's when you used to could buy, you can go in a store and $1. I remember as kids, we would go in the store and $1, we would come out with 2 or 3 Snicker bars and, all other kind of candy, Pop Rocks, Red Hots, whatever. You can buy all of that for $1. Now, one candy bar is almost $2. So that's inflation. So because cryptocurrency does not have a direct correlation with inflation, the number one reason why it should not be counted on for retirement is it has no correlation to inflation. You can't give it a dollar for dollar value. You can have a fictitious value of what you may believe it is. Like it's almost like they would do like gold, right? But there's a demand for gold, right? There's a demand for those types of investments. And so you can say the same goes for gold, but gold has a tangible asset. On the other side, it comes into something, gold, people use gold for different things, but there's nothing on the other end of cryptocurrency. That's what people don't understand. There's nothing on the other end. So where's a direct correlation with something that's not directly correlated to inflation, right? That's very volatile, meaning you can wake up tomorrow, you're down $200 billion in the entire market. And it has no regulation. And it's influenced by wealthy influencers, right? Who ordinary average people have a tendency to gravitate to, right? If I'm a normal everyday person, I'm an Uber driver, or I'm talking about full-time Uber driver. I'm not talking about people that drive on the side, right? I'm talking about people that's just trying to really make ends meet, right? They're hairdressers or people that are just small business people just trying to make ends meet. If they follow or are influenced by these wealthy investors, they say, hey, if that person's doing it, I'm going to put my last dollar in it, and I'm going to get into it. That is a recipe for disaster. There are going to be a lot of disappointed people. There will be, just like there was when it came to the GameStop, just like there was when people do that, right? There are going to be winners, but there's going to be a lot more losers, right? This is one of those games. There will be winners in cryptocurrency. I'm not going to sit here and tell you there will not be, but there will be a lot more losers in cryptocurrency. There will be, because if you're not a millionaire, then the long-term capital gains does not affect you because you're not a millionaire. But you may end up being a millionaire on paper with cryptocurrency, so it actually could affect you, right? But if you're not a millionaire today, you're not going to be able to, you say, well, I see no reason in getting out because you're not a millionaire. I don't have to be concerned with that because I'm not a millionaire. But the millionaires they're affected by it, so they're going to get out. If they get out, because they're the only ones that can really move the market, then they're going to affect the actual, the pricing of it, and it's going to drop it. So again, this is for the inexperienced investor. This is for the person that doesn't really know what cryptocurrency is, right? And it's almost, I liken it to two of the most difficult times that I've seen by being in stocks and investments. And that was the dot-com bubble, right? Back in the 2000s, 2001s, when everything just turned upside down, and the housing market. And it's because both of those were speculative. Both of those were speculative. This is not like, oh, I'm going to invest in the next Netflix, right? So Netflix was tangible, right? And if you would have came to me back then and said, hey, do you want to put $10,000 into Netflix? I was like, I don't know this company. There's no way they can take down Blockbuster, so I'm not going to put not my last $10,000 into a company I don't know about that's delivering videos. And they were delivering them then. They weren't even doing the digital like they're doing now. They were delivering them back then. I was like, no way, I'm out. Well, had I put $10,000 in, a company like that, I would have almost $1 billion from 10,000. I would have almost $1 billion right now today in value if I'd have put $10,000 in Netflix. That's something tangible. That's something that's the era, and that was the cusp where we were going at that particular time. But it was very evident of the changing of the times. We may be moving into digital currency. Not we may be, but we are moving into digital currency. Cryptocurrency may take over as a currency, but it can't take over as a currency if it has no correlation to inflation. If it has no regulation, because if it has no regulation, that's like me going out. The best example I can give you is when I was a kid, we used to play dodgeball, right? And there was another little kid. He was the best at dodgeball. No one could ever get him out. His name was Dexter. I'll never forget him. Little redhead kid. He was the best when it came to dodgeball. And that's like me now playing against Dexter or playing against the former me. Now I'm going on the playground and I'm playing and I'm bombing everyone, getting everyone out. Why? Because I am a wealthy influencer. I'm a wealthy investor on a playground with no regulation. There's no teachers around, no referees. I'm just hitting people in the head. I'm bombing them. I'm just get out of here, right? Because I have so much influence in a playground with no regulation, I can pump and dump. It has no correlation to inflation. A lot of people can get hurt. That's where my sixth point is the small investor syndrome. You are a small investor. If you have less than $1 million in a cryptocurrency, or you have less than $500,000, I'm not talking about what's the value of it now. I'm talking about what you have in it, what your cost basis is. You can't move that market. You can't influence that market. So you have the small investor syndrome. Most people that I know, right, I've run into, right, and people keep asking me, people keep sending me these DMs. Hey, should I get into that or whatever? How much you plan to put in it? Oh, I'm going to put 500 in it. I'm going to put 1,000 in it. You're a small investor. You should be concerned because you can't I will go a step further. This podcast is not about this, but I will even throw in Robinhood or some of these other free trading platforms. I have to tell you, just being in the history, being involved with the markets for 20 plus years, anytime my hairdresser, my plumber, or my Uber driver, or people just normal, everyday working class people are talking to you about stocks, I don't have a problem with that. What I have a problem with is their false sense of hope, thinking that they could turn the world upside down buying 2 shares of AT&T. Right? It's just not going to happen. Right? And I think people need to get regulated on what it is that they're doing. Now, with all that being said, so let me go back over. So we talked about no regulation. We talked about the IRS notice. That's 2. We talked about 3, pump and dump. We talked about wealthy influencers. That's 4. We talked about 5, no correlation to inflation. And we talked about 6, which is the small investor syndrome. You will always get taken out as a small player in a speculative investing environment. Anytime there's speculative investing, whether it's the GameStop or some of those other ones that people got taken out, and there are people that are lost. They're not going to tell you who they are. They're too embarrassed. But there are people that lost and will never be able to recover that money. Right. And so those are the people that concern me. Those are the people that keep me up at night. Now, if you want to add a little speculation to your portfolio, right? It says, I still want to be there if it happens or whatever. Buy it in some type of mutual fund, right? Don't buy it naked, meaning don't try to just jump out there in it. Now, there are some, I want to say Fidelity, and I haven't really looked into it too much, but I think Fidelity is kind of moving a lot of chips in on playing in that space. I'm not recommending any purchase of any mutual fund, no ticker symbol, no nothing. That's not what I'm doing with this podcast. What I'm telling you is there are some companies or some fund families that are trying to move into that space, but they are moving into it with floaties on, right? With a little protection built around it. I only reason why I bring up Fidelity is because I think Fidelity is part of a larger group that is trying to bring some type of stability to the actual overall. That's trying to bring some type of stability to the overall space, right? And I think, and I don't know right off the top of my head if they actually do have a fund or if anyone else has a fund. But from what I'm understanding, I think there are some types of funds that are indirectly investing in the cryptocurrency space. If you, as a retiree, want to get into that space, I would look at it as doing that with some type of protection built around it. I would not just jump into there, open my own account and do all that other stuff. I just wouldn't, right? And so the only reason why I was just giving you that is because I want you to be protected when you go in. And if you say, hey, I still want a part of that, it should not make up no more than 2-3% of your overall portfolio. Because it's like, hey, I tried, right? I hopped into it, wanted to taste it, see what it was like. You know, I ended up hitting the lotto, right? I got in it and it went up tenfold. You did good, but it's speculative. Any other speculative investment, that's the same thing. It's like buying penny stock. Buying stock that costs 3 pennies and it goes up to 25 cents or it goes up to $1, you've hit the lotto, right? It's penny stock investing. It's speculative investing. So that's what it is. I don't like speculative investing for my clients, as they need to be moving into asset preservation as the window shortens. I want to protect what I've made so far, so I'm going to move off of the speculative tip, right? If I am still in asset accumulation, yeah, and I'm still younger, and if I blow it, if I blow 10,000, if I blow 20,000, I can still work and put that back. If you are in your last window, which I call your last the 5 years to a retirement window, I would stay away from it. That's just me, right? That's what I would recommend for my clients, right? You seek out your own investment advice from your own advisor on this, if you were. But those are my disclaimers, right? But I'm telling you what I would do and what I'm telling my clients, especially if they're in a 5-year window. That's what I would say, dude. So again, this has been Jenny Jones. Hopefully this was helpful, right? I didn't get into a whole lot of the details of it. I just gave you some of the red flags, some of the things that stick out when I look at it, right? And I'm going to tell you another thing. If Warren Buffett is not in it, if he thinks it's a circus, that to me, I subscribe to a lot of his methodology because we both believe in dividends. We both believe in value stocks, right? And things that are tangible and things that people need, right? People need soap, deodorant, right? There's certain things that people need, right? And I subscribe to a lot of Warren Buffett's theories. If Warren Buffett is telling you, hey, it's a circus, it's too volatile. If he's saying that, look up what he said. I think he has about 10 quotes on record of the things that he said about it. If that's what he's saying, then you gotta, there's some merit to it, right? And so again, just wanted to share that with you. Again, the six concerns that I have, I'm going to give them to you one more time, is there's no regulation. The IRS notification being taxed, right? People think there's not tax. There's some reason people say there's no taxation. There is, right? The pump and dump, right? The wealthy influencers, no correlation with inflation, and the small investor syndrome. This has been Jenny Jones trying to help you get to your retirement exit by any means necessary. I want you to be educated. I want you to be empowered. This is episode 27. If you want to get more, you want to get a breakdown of some of how these things are going. If you want to see some of the things we have, what successful retirement looks like, we do have a series that's going to be starting soon on tv.myretirementexit.net. That's tv.myretirementexit.net. That is My Retirement Exit TV is coming. We're already there, but we have some more. We have a new series that's coming where we're going to be interviewing actual people who are in retirement now. They're going to be sharing with you some of the mistakes they made. They're going to be sharing with you some of the good decisions that they made on their journey and on their way to their retirement exit. That's going to be a very good series. Right now, we have a discount to get in. I'm giving, as founder of My Retirement Exit TV, 75% off for a lifetime to get into it. So it is an app. You're going to be able to find it. You're going to be able to find it in the Roku box. You're going to be able to find it on Apple TV. You're going to be able to find it in iTunes. You're going to be able to find it on iOS. You're going to be able to find it in your Google Play. So that's already there. It's you can find the app there. You're going to actually be able to find it on Amazon as well. So Amazon has apps. You're going to be able to find it there as well on Fire Stick. So it is My Retirement Exit TV. It's tv.myretirementexit.net. And we have 75% off. I think you can get it now for, I think, $50 a year. I mean, so I have a certain amount of coupons that I made available. But when we start interviewing and start talking to people who have retired, our first season is already booked, right? We're trying to finish some of the last minute taping now. It is going to be powerful. You're going to learn from people when they first start investing, where they made mistakes at, where they went wrong. If they had it to do all over again, what would they do? That's coming. My Retirement Exit TV. We already have some classes up there now. But if you want to get more, if you want to get down, you want to see with your own eyes instead of just listening to it on a podcast, I would become a subscriber now and get in while you can. So again, this has been Jenny Jones, episode 27. All right. Hopefully you guys are doing well. Take care. Be safe. Goodbye for now.